Good evening, everyone. Thank you very much for your attendance. I really appreciate it. I am Sensei Kevlar, and I'm here to speak to you this evening about the way of the trader. As always, I will start with the basics. The profitable trader wants to be profitable. Therefore, he will do what is required to ensure his long-term profitability. That means not using things like emotions and other non-tested, non-profitable ways of ensuring his profitability. It means trading a plan that has been proven to be profitable and using a strategy that has proven to be profitable. So the idea is that we will create a plan, and once we have planned out that trade, we will trade that plan. We'll do so by having a study of the prices and the markets that are going on in order to create indicators that will make a case for our positioning. Using several indicators and several cases, we'll build support for our position in order to devise a strategy. We will backtest and forward test that strategy. And once we have determined that this strategy is profitable, only then will we trade it by entering our entry trade, our exit trade, and our stop loss at exactly the same time into the market. This will be my final installment of this series, at least for the time being, and I hope that you've taken a lot away from it. Of course, there's always more to learn, and that's what I really wanted to impress upon you with these series, is that what I'm doing is I am skimming over a basis of some of the concepts that are really important to a profitable trader, and I'm trying to demonstrate the way in which you can use these things to work them together into a profitable strategy that will allow you to be profitable using your intelligence, your skills. People often ask me, what do you think the market is going to do next? And I find myself telling them a lot of the time, I really don't know what it's going to do next. I've looked at the price charts, I've looked at the indicators, I've looked at what's going on with the other traders and what they're doing and what they're saying, and I'm not sure. And that's okay. A profitable trader doesn't have to know what the market is going to do all the time. He only has to be right about enough of his trades in order to be profitable. And that's the way of the profitable trader. So I'm going to take a little bit of time this evening to cover a little bit more of support and resistance, because up until now, we've always worked with support and resistance being at horizontal levels, and I want to show you how they can actually be along diagonals and form other trends. And after that, I'm going to do a little bit of a preview of some more sophisticated and advanced trading concepts. Some of them I'll be talking about in terms of, we can break this down a little bit more, and others I'm just going to be giving a really quick cursory overview of. The idea is I hope to whet your palate with the information and that you will go and study it more on your own in order to make yourself more profitable and include these strategies into your own strategies in order to maximize your profitability. And with some of these advanced concepts, the idea is to supercharge those strategies. So let's begin. I'm going to pull up the trading view real quick. And we'll take a look. Here we are on the 4-hour chart. And I really like the 4-hour chart for Bitcoin a lot. One of the reasons is it exposes long-term trends in a very easy to digest manner. And so up until now, whenever we've talked about support and resistance, we've always drawn those lines in sort of a horizontal fashion. When we come in here and I say, oh, look, here's support that it found at this level 3 different times on that horizontal line right there. And previously, that had been resistance, and that's something that's been very significant in the market over and over again. Is when we find resistance and then we're able to break through it, that resistance tends to turn into support. So there's another way that these support and resistance lines can actually signal the direction the market is going to go, and that's that if you look, here's a good example of what I'm talking about. I'm just going to zoom in on this a little bit more so we can kind of get a bigger picture of it. Now, clearly, we have a support line that is happening right here at 215.69. It's coming in and it's knocking on that one 3 times. But there's another trend line here, a resistance trend line, that is also forming. And so I want to point that out to you really fast. It's this one right here. And it comes from here and it extends downwards through here. Okay? You take this point, it touches this point, it touches this point, it potentially touches this point. But then look at what happens, is we were on this lowering resistance trend. And as soon as we reached, so you see this wedge that is forming right here, this wedge pattern that's forming right here? This is a consolidation pattern. This is where the market and the whales are consolidating their position in order to maximize their profit for the next opportunity. They're just letting the market go up and then waiting for it to come back down and then buying back up, and then waiting for it to come down and buying back up, and then waiting for it to come down and buying back up. And then when they're ready, they can go ahead and push the market back up on just a little bit of volume and then start selling off all of the coins that they accumulated back here. Okay. Now, this is a really common trend in the market, and you'll see it if you look carefully over and over and over again. But here's what I want to call your attention to, is these types of trends, when they form, they can signal to you when a trend breakout is going to occur. Because here we have a line, and it's, the line has been basically followed for a good number of 4-hour periods here. It was initially established here, found again here, and this is where the trend formed for the first time, that we could really sort of see that there was a downward trend. It touched it again here, again here, again here, but when it reached here, instead of going back down to meet this right here, what happened? It broke out of the trend. And so that was our first opportunity to see that we had broken out of the trend. And that could have been a really strong signal to us that there had been 3 taps on support. 3 times we decided we do not like this. Okay, we do not like this price. We want this price to go higher. Meanwhile, the market is trying to get it to come down to do accumulation at this level, obviously. Every time it comes up here, we just sell off again. And then when it comes up here, we just sell off again. Okay, so the point is that once we've seen that the market is not going to be able to go lower than this 3 times, and that the trend, which has been, trying to get it, the trend has just been keeping it at this resistance line right here. When that trend gets broken, whatever was keeping it down is no longer keeping it down. And that's when we can expect to see a breakout above. Okay. Now, can we find the opposite thing, the opposite situation in the market when going down? Yeah, of course we can. Over and over and over again. Let's see if we can find a place where, here's a good example right here, where we have this nice long trend. Here's a good trend right here. Put it through all those bars. We come down and we touch that bar. If we just extend that line and we try and continue that trend that was so strong all the way through here, all the way down here, look at what happened right here. We finally broke the trend. Okay. Now the same trend also formed on the other side of this right here. Okay. But what happened is, if we had seen it break through this trend, if we had seen it come down even more, that might have been a sign that we could have gone short on this. But instead what we saw is we saw it break this downward trend right here, right? And so this could have been our buy signal right here, as we've gotten 3 bars outside of the trend, whereas before we could get no bars outside of the trend. So 3 bars outside of the trend, that starts to form a new strategy for us, right? Because here we have 305 to 320, or 335. That's a profitable trade easily. Very, very, very profitable. And it's only over a couple of days. That's about a week right there, week and a half right there. Okay. Same thing here. We've got, these types of trends where the support, the rising support or the falling support forms some sort of wedge or some sort of, breakout, some sort of megaphone, where you have this effect where the trend then gets broken. Okay, so three candles. Here's 3 candles right here. Can we turn this into a profitable trade? This is 377. We would probably put our exit somewhere right above 400, our stop loss right above 400, like 411, and we'd be targeting right down here, which is 350. So if we were looking for 378 to 350, we could get that right here. Again, this is about 2.5 weeks right here. So this is a very profitable signal, and following this signal back, this signal shows itself in the market over and over again. Here it is again, okay, where we've got, and here we have a situation where we were just able to get 1 bar outside of the trend line before we broke through. So we weren't able to get 3 bars outside of the trend line. And so far, the 3-bar strategy is holding. And this is what I want to impress upon you. If the 3-bar strategy doesn't hold in the market, go for the 4-bar strategy. Look for 4 bars outside of the market. See if you had done your entry there, if you could have been profitable there. So here we don't see 3 bars, so we're not going to consider this a short position yet, right? Let's continue. Here we're going to see 1, 2, 3 bars outside of the trend. See the trend here we did not see 3 bars outside of the trend. Here we did see 3 bars outside the trend. So we're going to short on this one because we moved outside of the upward trend. We're going to go short at 392. Stop losses at above 420, targeting 323, 392 to 323. Easy. It's easy. This is so easy, right? So you could just do this over and over again. Look for these. Look for these right here. Here it is again. Bring that right on down. Okay? So let's say we're here, right? Let's say we're here in the market today and we've got all this room over here, right? What I'd do is I'd say, okay, look at this trend. This trend, it's going, it's going, it's going. What I'm looking for, trend, if we're here, I'm saying trend is not over yet. Because look, I just drew the bar through this one, through this one, through this one. Trend is not over yet, okay? But here's 3 bars outside the trend. Now, if I traded this to go long, because we're trying to look for the trend reversal here, if I traded this to go long, 330, let's call it, I'd be looking for 360 with a stop loss below 290. There's my 360 right there. Okay. This is one of the most powerful indicators that I've ever seen in this particular market. And that's why I've sort of saved it for the last episode, is because this one, above any other, almost always, when done correctly, signals true. And it's one of those ones that you should be incorporating into your larger strategy. And when I say your larger strategy, I mean you don't just wait for it to break through. You wait for it to break through, and then you correlate it with the other strategies that you've got going on. Where's your RSI? Where's your MACD? Where's your futures? Well, let's take a look at the time that, where the futures were. Let's turn on the futures line. Futures hadn't started yet. They weren't available on OKCoin at the time, right? They didn't start until almost the beginning of this year. So we don't have that data available to us. What about arbitrage? What was arbitrage doing at the time? Well, Bitstamp was pretty much in line. BTCE, also pretty much in line. Take a look at your momentum indicators. Your momentum indicators are telling you that everything has come down recently. Take a look at your volume. Your volume has told you that there's been a lot of interest at Bitcoin at this price right here. Okay. Your moving average convergence divergence is showing that we recently had a big sell, but here's a cross of the moving average convergence divergence. Your ultimate MACD is saying something probably very similar. Yeah, here's the cross on the ultimate MACD. The slingshot is telling you that we've definitely been doing a lot of coming down. That one's not very good on this particular time frame, but it definitely works on other time frames. And then here's a Tilson T3, and this is also telling you that this is probably a good entry point for this, right? This particular signal, let me turn off some of the other ones so you can see it better. This particular signal usually tests very well, especially on longer term charts. And this is just a basic Tilson T3. This has been around for since the start for a very long time. So if you look at this one trades especially well, right? If you had just literally done nothing but traded this signal alone, I bet you could have been really profitable, right? Even on the ones where you had a little bit of chew on these, like right here, where you got chewed up on the market on your fees a little bit, even with these, like you could have gotten chewed up on fees. You would have made it all back right here. Look at all this right here, right? So these should be used in conjunction. They should be used together. They should be used in a way that, informs your position and builds a case for your position and allows you to build up that strategy and allows you to continue to develop that strategy, because you're not going to be able to just pick a strategy and then use it. You're going to have to continue to adopt that strategy. Like even now, futures used to be a really strong indicator, right? And it's not anymore. It's now changing. And it's not necessarily changing rapidly, but there's definitely starting to show some fluctuations in that strategy of using futures as an indicator on the arbitrage. So you have to continue to test that strategy, and you have to continue to adopt that strategy to new market conditions. Okay, so I'm going to go back to the 1 hour chart, and I'm going to talk about some more ways of supercharging your strategy. I'm just going to turn off a few of these indicators now that we've gotten those out of the way. And of course, the final thing that I will mention is when doing multiple correlation of signals, do them on different time frames. If you've got an RSI that looks good on the 1 hour chart, go check it out on the 4 hour chart. See what we haven't recently gone up recently, or the 1 day chart. See if this isn't, a rather recent trend change that you're seeing on the 1 hour chart. Correlate these things. The more signals you have, the more correlation you have against this, the stronger your indicators and the stronger your position. Okay. So now let's talk about some slightly more sophisticated approaches for positioning and how to supercharge your signals and how to supercharge your positionings. Okay, let's say that we're here in the market. This hasn't, the future hasn't occurred yet, and we've decided at this point that the market has just come up too much. We're looking at this and we're going, you know what? It's recently done a lot of coming up, and when we look back here, it's done a lot of coming up. It's now here. It started to give off. I think that it's really showing signs that we're due for a big sell-off. If you look at the cycles say it's time for a sell-off. If you look at the RSI says it's time for a sell-off. If you look at the MACD is up too high. If you look at the futures are above. Everything is telling me that I should be shorting the market. Okay, and so I've now back tested this strategy, and I have the confidence that I need for myself, not for anyone else, because I'm not telling you to short the market. I'm shorting the market. I have the confidence that I need to short the market and realize a profit and hopefully realize a profit using this. And I have tested that if I short the profit under these conditions, if I had done this consistently under these conditions in the past, I will be profitable. So I'm going to go ahead and I'm going to decide to short the market. But what I'm seeing is that the market's not quite ready for me to short it. There's a lot of opportunities in here. If I short it right here, then I'm just missing all of this opportunity. This is $4 worth of opportunity, right? That I could have, if I had just waited for a little bit longer, man, I really missed out on $4 worth of opportunity. And that's $4 that, times 100, that's $400. I like that $400, right? I want that $400 worth of profit. Okay. So what I'm going to do is, now that I've decided I'm going to go short and I'm here, we are here in the market, I've decided, man, I think it's ready for a dump. I think it's just about to go all the way down. Okay. I'm sure of it. Okay. What I'm going to do is, instead of just doing the standard one position here and one position here or something like that, I'm going to try a little bit more of a layered approach, because I'm not really sure what the total range of this motion will be, but I know that the way that the market is acting right now, it's liable to go up a bit before it does that major move downward. And so I want to capture as much as I can of this. Okay. There's two strategies that I use for doing this. One strategy is the layered limit strategy. The idea here is that, I like 240 for a short. I'm okay with it. I think that 240 is a short. I'm going to go ahead and take half a position and go in at 240 short. Okay. The other half of the position, I'm going to put a sell order in at 242, one at 244, one at 246, and one at 248. I'm going to break up that half of a position into 4 more sub positions, and I'm going to put them in all the way up. And then I'm just going to let them go. And when the market comes up, when I wake up the next day, I see that my 244 has been hit, and my 242 has been hit, but my 246 remains and my 248 remains. Okay, so I go, okay, fine. Then the market comes down again. I'm like, okay, fine. Then the market comes up again. I'm still not getting my 248s hit, still not getting my 246 hits. That's fine. Okay. At this point, what I've done is I entered short here, but I'm raising my average positioning up in order to capture more of this opportunity. The problem, though, is that I don't know when the drop is going to happen. I don't know that this is really going to go. And so I don't want to risk it. I want to position myself for the immediate drop and for the up and then drop. And if I position myself for the up and then drop, I can take more profits on that by layering in my limit orders. Okay, so just moving that up. And then as soon as so I start out here, I'm selling up to here. My average position is somewhere around 242 by the time I'm done. I'm done selling up to 246, and then the drop happens. So I captured an extra $2.50 worth of profit by using the layered limit strategy. Okay. Now, the other strategy that you can use, and this one's a bit riskier, and I don't recommend using it as often or as freely, but it certainly can work in the right type of market conditions, and that's the trailing stop approach. The idea here is that in certain markets, popular markets, you can enter what's known as a trailing stop order. For instance, what I would do is I would say, well, this market has a range seems to be stuck in a range of about $4. Okay. And what I think is going to happen is it's going to go up no more than $4. But if it goes up more than $4, I don't want to be, short at the middle of the market when I could have been short higher up in the market. Okay. So I'm going to set a trailing stop. And I'm going to say that it's going to be $5 below the market. So what that means is I'm prepared to sell $5 below the present market at 235. Now, hopefully, the market doesn't just charge right through that and get hit and then stop at 235. And that's the danger of a trailing stop, and why I don't suggest using it unless you really, really, really know what you're doing here. However, if the market were not to go to 235, instead it would go from 240 to 241. That trailing stop would come up by that amount. It would come up to 236 all on its own. Okay? If we went from 241 to 242, the trailing stop would come up to 237. 242 to 243, trailing stops up to 238, and all the way up. So it'll trail the current market by $5. And every time that the market has gone above it by more than $5, the order will move itself up in the market. Okay. And then when the market comes back down, it will hit that order. Okay. So what this allows you to do is, in a market with lots of volatility where you think it's going to go up a little and it's going to go up steadily before it comes crashing back down, a trailing stop will allow you to push that order higher as the market goes higher. Now, the danger is, of course, that you could have been shorting at 240, but instead, because you tried to use a trailing stop, you ended up shorting at 235. And that's a danger. The other danger is, of course, that, it does one of these on you, right? It just hits you, it brings your trailing stop right up, only to knock you back into it, right? Only to then turn around and go even higher with you already in your short. Okay, so the layered limit is a much safer, much saner approach. It allows you to completely understand what your positioning will be well ahead of time. The trailing stop is a much trickier proposition, and I definitely do recommend trailing stops for exiting. Using them for entering can be a very interesting proposition. So let's talk about how we can use them for exiting. And again, this falls under the category of supercharging our position. Okay. In the case where we are going short, we're going to go short at 240. We're going to layer up to 240, 248. We're going to get hits up to 244s. It's going to bring our average position up to 242-ish. 241, 242, somewhere around in there, okay? Now, our targets, well, we don't have to take the target all at once either, okay? What I recommend for the strategy that has worked really well for me in the past is as follows. I have my initial target. Say it's 235, okay? This is a well-supported resistance level, 235 right here. I think I can hit just above this, go for through 236. It's right in here where this previous resistance occurred. I'm pretty happy with 236, okay? What I can do is I can go ahead and put my limit order in for half of my exit at 236. So if I went short one Bitcoin at 240, I'd put in, half a Bitcoin of exiting that position at 236. And then I'd put in another trail stop, $1 above 236, or $2 above 236, okay, like 238. So what does that mean? Well, what happens is now the remainder of my exit is at 238. Okay, but it's going to trail the market as the market comes down by $2. So right now we're at 235. My exit is at 237, or we're at 236. My exit is at 238. As the market, hopefully I don't get hit on my 238. I got hit anyway, so it didn't work for me. If I had put it at 238 and 238.50, it would have worked though. And so this is where strategy backtesting comes into play. Where do your trailing stop losses go in order to not get hit prematurely? Okay, so as the market comes down, what will happen? Let's find a place where the market is coming down. I'm going to zoom out a little bit. Here we go. Here's a good example. Okay, in the case where the market is coming down, I'm going to take my initial profits right here. Okay. But I'm going to put my trailing stop in right up here, okay? And as the market comes down, so will my trailing stop. So will my exit price automatically on my trail stop, okay? And it'll come down, and it'll come down, and it'll be about here, and the market will come up and not hit my trailing stop, and then the market will come down more, and it'll pull my trailing stop down more, and then it'll finally come up and hit my trailing stop, okay? The difference was between 221 and 226. That's $5 worth of profit by holding out for that trailing stop, okay? So what that means is I can make the strategy work for me every time, because that trailing stop, even if the market hits my profits and then comes back up and hits my trailing stop, I'm still in profit territory. I'm still making money here. This is still a profitable trade for me. I do not have to exit my position all at once, because my trail stop will exit my position at a little bit higher than I otherwise could have, but at the opportunity for much greater upside if the market continues to go down. Okay? So that's what I'm talking about when I say supercharging your strategy, is if you start to incorporate all of these types of strategies into your backtesting, and you start to really get clever with your positioning and clever with your money management and clever with the way that you place your orders and position yourself in the market, you can really take advantage of some of these trends in a big way. And you can really develop a strategy that utilizes these trends to your advantage. The fact that even when the RSI is really high, it still tends to do things like come up and do a second test of that. Or even when the MACD is, crossed over, it still tends to go up and then before the big sell-off, and it still tends to do the consolidation pattern, the wedge pattern of increasing allocation, and it still tends to do it still tends to have moments of pause before the breakouts. And so these are the signals that we have to incorporate into our strategy. And when I say we, I mean you, because I'm not trying to sell you a strategy. I am not selling you an indicator. I am not selling you a system. I am not selling you a way to make money off of my ideas. I am trying to explain to you a way to use your intelligence and your abilities in order to make yourself profitable. So if you're coming to me and you're saying, so what do you think the market is going to do next? I'm just going to tell you, go look at the indicators. Go see what it's going to do next. That's the point of this. Build a strategy, backtest it, make sure it's profitable, and then trade it. Don't listen to anybody else except what it is that you know to be true for yourself and what you know to be profitable. Because nobody else is in this to make you money. They're in it to make everybody and to make themselves money. The only person who's in it to make you money is you. And so you're really the only person who you can rely upon to tell you which way the market is going to go. You're the only person who you can say with any certainty, yes, I have done this before, and I know that I will be profitable if I do this again. And that is the way of the trader. So as a quick preview, I'm just going to go over a couple more very sophisticated concepts. It's not that, they're hard to understand. They're just hard to execute. One of those ideas is that when we're doing all of these different indicators, I'm just going to bring up this chart again. When we're doing all these different indicators, like the RSI, like the MACD, which I haven't actually shown you, but it's a pretty common one, the moving average, convergence divergence, like the Tilson T3, like the Tilson TX, using futures as an indicator. All of these, support and resistance, breakout trends, all of these things. All of these signals are all going to be valid at different levels of confidence on different time frames, and more specifically on those different time frames at different parameters. Now, what do I mean by different parameters? Well, in the case of this RSI, if you're looking at this RSI, presently we're looking at it on a 1-hour chart. Now, if you look at the exact same data, but you roll it up to a 4-hour chart, you're going to get a different picture of the world entirely. The RSI is going to go up and down in different places because the chart's going to be going up and down in different places. Then if you move it to an even longer view, you're going to get an even different view of things, right? Because according to this, if you're looking at it on the 1-day chart, it's been, it hasn't even left the middle since the beginning of May here, right? But if you look at it on the 45-minute chart, you'll know that the market is really all over the place in terms of its volatility. It's just that the overall trends have recently become very compressed, and that's what I'm trying to show you on the different time frames. Okay. What's more is that these indicators are also going to indicate differently on the same time frame using a different set of parameters. Now, if you remember when we constructed the RSI consisted of something very important. And I can bring up that document really quick if I can find it here. The RSI consisted of something really important. Here it is right here. RSI consisted of something really important when I was describing it. And that is, the moving average of the gain over a time frame and the moving average of the loss over a time frame. Now remember that the numbers that are being plugged into here, the gain and the loss, this has already been rolled up on the 1 hour. Okay, so the numbers that are being plugged into here are already on the 1 hour. The time frame that we're referring to when we talk about the MA is how many candles back we're looking. Okay, so in this case, we're using an RSI with a moving average of 14. Okay, now if I change that to be 7, you're going to look at much less data in your RSI, and your RSI is going to become more pronounced. Okay, if you change that to 20, it's going to look at longer periods of time, and the RSI is going to become less pronounced. Okay, so these indicators will indicate differently across different time frames and across different parameters. And those parameters can be optimized. You can treat this problem as an optimization problem, which computers happen to be really good at optimization problems. There's a lot of cool techniques for dealing with optimization problems. So what you're trying to do is you're trying to produce a signal that, for instance, let's try and optimize the RSI signal. And what we want to do is we want to produce an RSI signal that whenever it goes below a certain number, it has to go first above and then below a certain number. That's a short signal. And then when it goes below and then above a certain number, that's a long signal. And then what we want to do is we want to optimize for profitability, where the parameters that we're optimizing for are, number 1, the time frame that we're rolling up the data on, number 2, the period of the RSI for the moving average, and numbers 3 and 4 are what value we're going above and then below for our short signal, and what value we're going below and then above for our long signal. So there's code. If you're not a coder, it's probably going to be pretty boring to you. But the idea is that we can write code in order to test these things. And so here's an example of an RSI. Here this is all my code that I've written myself. Here's the example. If you know the RSI, there's that formula once again. Here we are computing the moving averages. We're taking the aboves, dividing by the belows, and taking that's our relative strength, and then computing our relative strength index. And then we're saying if the RSI is overbought, then we should go short, and if the RSI is oversold, then we should go long. And then what you do is you just try this. You have the computer try different time frames, try different parameters, different lengths for the EMA, try different values for overbought and oversold. Now, if you were to do this in a brute force way, if you were to try every possible combination of parameters of the overbought, the oversold, the long and the short, the MA time frame, and the roll-up period, this would potentially be a very, 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 very large number of things that the computer would have to try, and would potentially take it a very, very long time. And so we can use other tricks like evolution. And so here's an example of me using an evolution and a genetic algorithm to optimize the RSI. And so when I fire this up, what will happen is I've been recording all of the ticker data from all the exchanges for a little over a month now. That's publicly accessible information. And if you're interested in accessing it yourself, the reason being is because the exchanges don't offer historical data more than 1,000 trades back. You can go to cryptomarkets.firebase.io.com. That's cryptomarkets.firebase.io.com, and get all of the data yourself and see all of the data for all the exchanges and all the live trades and everything. Since this is a Firebase, it can actually get published to you in real time, so that's really handy. But what you can see is that, here, I'll move this out of the way. What you can see is that we're starting to find an RSI that if we had traded it, would have given us $24 worth of profit. And specifically, this is the time frame, and if we do the math on what that time frame is, you'll probably find it's a significant time frame. So I'm just going to pull up a calculator really quick here. Let's just stop this. Okay, so we're going to take this time frame. We're going to figure out what this time frame actually is. This is in milliseconds, and so we've got to divide it by 1,000. And then we've got to divide that by 60. And again, yeah, that's almost the day roll-up chart. So on the day roll-up chart, when the RSI went above and then below 70, or below and then above 35, and we were targeting $11 of profit with a $1.4 stop loss, with a 4 EMA on the moving average, then that signal did really well for us. So let's go take a look at what that actually turns out to be. So here we are. Let's move to the day chart. We'll take the RSI. We'll go to 4 on the length, and then we'll do a style and make it so what was the 70 and 35. 70 and 35. Yeah, sure enough, okay. Here we would have gone long. Here we would have gone short. Here we would have gone long. Here we would have gone short. Here we're going long. Right here. Okay. Right there. See where it touched 30? So I've only gotten data back to the 15th of May, or 15th of April, which is why I can't tell you any more of this. But that's the idea, is that these signals can be often, if you look, it's actually pretty right on. It would have gotten us all kinds of, I can tell you how much cash it would have gotten us if you had just traded that. It would have gotten you $31 worth of profit captured correctly, right? So we can see that optimizing these signals and looking for them on different time frames and allowing us to use the computer and use the computer's tools in order to find the signals that are relevant can be a whole lot more effective than searching for them ourselves. And so here I am again on the markets, and you can see that I've been capturing all of the major, I'm not sure, oh, I realized it got screwed up there. All of the major markets and capturing all of their trade information so that I can do, automated analysis of signals against them. And that's what this project here is. People have been asking me about this. This is on my GitHub. It's github.com/tsavo/arbi, ARBI. It's all in here. All this genetic optimizing stuff for signals, it's all in here. So if you're interested in coding and interested in learning more about genetic optimizers, there's other stuff in here like neural networks and predictors and stuff like that. The point is that a professional trader will use every single tool that he has available to him to his advantage. He will constantly try and make his signals more profitable. He will constantly try and optimize for that profitability. And I invite you to constantly be learning about the indicators that are available, the signals that are available to you, the studies that are available to you, and keep on being profitable. Keep on making a plan and trading that plan, because that is the way of the profitable trader. I hope that you have enjoyed this. I certainly have enjoyed doing it. And since I have no questions, I'm going to wrap it up. And I hope you all have very profitable trades. I hope to see you on Slack, on Skype, on Reddit, and in the Whale Room, and all the places that we meet. Good night, everyone.